Good morning, and welcome to Riveron's latest Ask the Experts webinar. My name is James Lee, and I serve as the firm's geographic leader for both our Denver and Houston markets, as well as national practice leader for energy. Given the latter role, I'm particularly interested in what our experts have to say. So, let's meet the experts. First, I'm very pleased to introduce Paul Jansen with Conway McKenzie, now part of Riveron. Our firms joined forces in December. Conway McKenzie brings more than 30 years of experience and more than 100 professionals well-versed in navigating change in a distressed environment. Paul is an experienced leader in that practice. Our combined resources now exceed 500 professionals across 14 offices. Also joining on our panel today is Scott Mell, a 25-year veteran in the restructuring space and a senior leader in our turnaround practice. Our next panelist, Zach McGinnis, leads Riveron's capital markets practice and advises clients on complex SEC reporting matters and capital raising transactions of various types. Also joining us today is Damon Cade, who leads our performance improvement practice in the energy industry. Finally, Jason Tucker is a manager on our capital markets team and has led multiple projects assisting clients on technical accounting requirements resulting from distressed environments. A few key reminders. Riveron now hosts a webinar monthly. Our next webinar is scheduled for March 12th. There will be 4 polling questions that need to be answered in order to obtain CPE credit. If you have questions, please feel free to submit them using the Q&A option in Zoom. Evaluation forms and CPE certificates will be emailed to you. After today's discussion, you will receive a follow-up email including access to this recording and presentation materials, as well as the ability to join our mailing list to receive future invites, and contact information for all of our presenters. Quickly, to cover the agenda today, we'll provide an overview of the current bankruptcy landscape, some core definitions, principles, and considerations, the accounting implications and considerations for fresh start financial reporting, some specific operational considerations for the oil and gas industry, and finally, emergence readiness planning as organizations prepare for life after restructuring. With time permitting, we'll offer time for Q&A. So let's begin with a polling question. Which factors does your organization view as the biggest potential threat to continued profitability growth? A, interest rates, B, geopolitical factors, C, international trade wars, D, the labor market, E, other. As participants register their opinions, we'll turn it over to Scott Mell, who's in our New York office today, to describe for us a little more about the current bankruptcy landscape and some core definitions.
Good morning, everybody. Thank you, James. This is Scott Mell in New York. It's a rainy day here, and as I look at the responses on the screen here, it looks like geopolitical factors are the #1 concern of this group relative to 2020. And I would argue that we are in a great period of uncertainty as we sit here in mid-February, given it's an election year, the ongoing global trade disruptions that we're seeing, as well as recent events with the coronavirus in China. And I think there's already being impact felt here in North America, both in the retail and automotive space, given their dependence on the supply chain coming out of Asia. So interesting times here. So let's move on to the next page, please. Thank you. So what I want to get into with this group here is to talk about a very difficult subject for most C-suites, which is distress situations and the opportunities that arise with a bankruptcy process. And as background, we wanted to delve into a bit what Chapter 11 is and what the opportunities that may arise for an organization with that process. And the page 7 here, we talk about the statistics of the trends in Chapter 11 filings in North America. Specifically, this is the US, and you can see that obviously during the previous recession and ending in 2009, 2010, substantially higher rates of Chapter 11 filings. For basically the past 7 to 8 years, we've seen historically low statistics of Chapter 11 filings, just given the ongoing growth sort of on a macro basis in all industries in the U.S. But I will tell you that we've started to see here in the last, what I would call 6 months, the statistics starting to pick up a bit. Specifically in January of 2020, while it's not on these slides, Chapter 11 filings were up 70% plus year over year for the period of January. So obviously that's being led significantly by specific industries. We've seen, energy continues to have great disruption. Obviously, retail is in a period of change holistically in that space. And then we're also seeing healthcare being meaningfully impacted given some of the legislative and regulatory changes coming out of Medicare and Medicaid. It's meaningfully impacting that space. We've also seen recently some leading indicators that folks in my world, which is restructuring, look at starting to pick up and be indicative of future stress in the economy, specifically high yield junk bonds. The default rate on those historically in the last 24, 28 months has been around 5%. That is substantially higher than where they were in 16, 17, which was around 1%. So that's starting to creep up on us. For comparative sakes, during the last global financial crisis in 2007, 2008, default rates on those high yield junk bonds were closer to 15%. So while they're starting to move, they're nowhere near where they were at the peak of the last recessionary period. So we're keeping a very close eye on that leading indicator. Let's go on to the next page, please. So Chapter 11, obviously not a term that most C-suite folks want to be muttering to their board, but it does provide an opportunity for an organization to address many of the financial and operational challenges that they face. Specifically, it basically puts a pause on the ability of any creditors to take action against the company, provides what we describe as some breathing space to understand strategically what is the opportunity to address both balance sheet challenges as well as performance challenges from an EBITDA and earnings perspective. So when the company files Chapter 11, it essentially gives them a chance within the construct of the federal court system to prepare and present a reorganization plan to their creditors that provides for recoveries for the creditors and defines a path forward to fixing the business and returning it to the stage of being a going concern in terms of able to meet their obligations as they come due. Let's move to page 9. So some of the core principles within the Chapter 11, obviously one that I just described is called the automatic stay. Essentially, it prevents any creditors, whether they be supply creditors, lenders, and even litigators, folks who are pursuing litigation against the company, from pursuing that action against the company. And we're seeing that quite a bit now in the pharmaceutical space, where many of these large opioid producers are filing bankruptcy to basically stop the litigation and give them an opportunity to negotiate settlements with the various municipalities, both state and federal, that are pursuing litigation against them. So that's an interesting dynamic that's happening in pharmaceutical space right now. More often than not, the company within a Chapter 11 remains in charge. The management team remains in charge as a debtor in possession. So they retain the ability to make decisions via the management team and the board. So there's no replacement of the management team. There's no replacement of the board. There's no legal obligation to do that. Sometimes, sponsors will make changes, but again, the debtor remains in charge. And the overarching theme of Chapter 11, or the objective, is to maximize value for the estate. And it's an interesting concept because it's different than what a management team's fiduciary duty is outside of a Chapter 11, right? The obligation of the management team and the board is to maximize value for the shareholders. That pivots within a Chapter 11 context to, you now have a fiduciary duty to maximize the value of the estate, and that's on behalf of all constituents, including your creditors, your trade creditors, your lenders, your bondholders. So it's an interesting concept for management teams to understand as they move into the phase of being insolvent and potentially having to file for Chapter 11. Elimination of pre-petition debts and equal treatment of creditors. Essentially, the Chapter 11 process allows you to address your debts, to do a quantitative analysis of what is the underlying value of the enterprise, and then accordingly negotiate a recapitalization of the company based off what level of debt service the new organization can sustain on a go-forward basis. So let's move to page 10, please. Over the last, I would say, decade to 15 years, the Chapter 11 process has evolved quite a bit. Typically, going back 20 to 30 years ago, you would see mostly what we describe as traditional Chapter 11 bankruptcies or unplanned bankruptcies, meaning you have companies that essentially, for the most part, ran into liquidity constraints, were unable to pay their trade creditors, were unable to make principal or interest payments on their debt, and essentially had to seek protection in courts to prevent those creditors from pursuing legal action against them. That was far and wide the most frequent type of Chapter 11 that we saw. What we're starting to see over the last decade is companies in the process becoming a bit more sophisticated and strategic. And so two new two new strategies have started to evolve, which is the prepackaged bankruptcy and the prearranged bankruptcy, which essentially is the debtors are doing most of the negotiating and legal work of a bankruptcy before they even file bankruptcy. So they're identifying that they're going to need to seek Chapter 11 protection. They're starting to engage with their creditors very early on and seeking to negotiate a settlement and a resolution before they even get into court. And one of the driving factors behind that is obviously going through a Chapter 11 is very expensive, both from raising capital as a debtor in possession to the associated legal and advisory fees that are associated with Chapter 11. Plus, obviously, the risk to the business of a company being in Chapter 11. The longer you're in Chapter 11, typically the larger the degradation of the underlying business. So folks want to get in and they want to get out. So the prepackaged and the prearranged bankruptcy allows companies to negotiate with their creditors and go into court day one and tell the bankruptcy judge, Your Honor, we've spent 4 months with these bondholders and with our trade creditors, and we've reached an agreement on how to restructure the business. And more often than not, if you have consensus amongst the constituents, the bankruptcy court and the bankruptcy judge will approve a prepackaged or a prearranged bankruptcy. And you've seen cases where companies spend as little as 30 days in Chapter 11 if all goes well. Obviously, the ability to do that type of transaction is heavily contingent on the amount of debt and, frankly, the structure of the capital that's in the organization. The more tranches of debt you have, the more number of bondholders and debt holders, the harder it becomes to get everybody aligned and build consensus. So let's move on to page 11, please. Great. So the bankruptcy process affords great opportunity, as I mentioned earlier, to debtors to address their operational challenges. One of the biggest opportunities is the ability for debtors to either assume or reject contracts. So the legal term is executory contract, which is essentially a contract that requires both parties to provide services under. Typically, it's one party is obligated to make payments, the other side is obligated to provide services. So when you file for Chapter 11, you have the ability to look at all of your executory contracts and decide, are they in the best interest of the business going forward? Or if they're not, you have the ability to reject those contracts, and essentially that contract holder on the other side then has a claim against the estate in the bankruptcy and will get some type of recovery based off the relative value of the enterprise. But it's very valuable tool in a number of different industries, specifically in retail, as well as specifically there's been some value in the energy space with these types of executory contracts. In the retail space, essentially, if you're a retail institution and you have a bunch of underperforming stores, you can seek to close those stores and you can reject the lease you have with your landlord. So that enables you to limit the cost of getting out of those stores, which you otherwise would not have the ability to do so if you're outside of bankruptcy, because if you default on a lease agreement, there's penalties, and the landlord has the ability to seek compensation for the term of the lease. So you often see retail Chapter 11 debtors, using this tool to exit unprofitable stores. It also is pretty common in the upstream E&P space for exploration and production companies. And there's some uncertainty on this particular point around their ability to reject gathering contracts with midstream companies. We've seen some recent legal court opinions in the Alta Mesa Chapter 11, and going back a few years in the Sabine Chapter 11 case, where different courts have had different opinions, but for the most part, the courts have decided that exploration and production companies can reject gathering agreements, which typically, what you see is you have these E&P producers falling below the production levels they had anticipated. They have take or pay agreements with the midstream pipeline companies. And so it's an overly burdensome cost to them, given that they're not pumping the level of oil or gas through the pipeline that they had expected. And so they're going to the courts and asking to reject those contracts with these gathering companies, these midstream companies. And so that's been a lever that has been frequently pulled in the Chapter 11 process in the energy space. Let's move on to page 12. The second opportunity that the Chapter 11 process provides debtors, that is increasingly becoming more common, is the ability to sell yourself within the Chapter 11 process, either sell individual business units, sell assets, or sell the company as a whole. And the term is Section 363 sale process. You've probably seen that. Section 363 is the section of the Chapter 11 code that basically covers this. And essentially, it provides the debtor the ability to get the highest and best offer for the sale of their business or their assets. And so it's very closely managed in the Chapter 11 process. The law requires the debtor to run a transparent process to ensure that you are in fact selling the business for the highest and best value. And so there are rules of the game for the process, which is essentially an auction. Typically, the way it works is a debtor will hire an investment bank to go out and market the business. They'll find what is described as a stalking horse bidder, so a party that is willing to put in the first offer. And then you go to court and you negotiate with your creditors what the terms of the auction will be, what will the rules be relative to other people coming in and bidding for value. And then eventually you get to an actual auction where you spend a day in a bankruptcy courthouse and you have various parties coming in and putting offers in front of the debtor. And then you have to eventually choose one and go back to the judge and have them approve the transaction. But it's a process that is structured to allow for the debtor to maximize the value of the assets or the operations that are being sold. And it can take anywhere from 45 days on the low end. More typically, it's 120 days to get a transaction done. And sometimes if there's great debate relative to the process, it can take 6 months. Let's move on to page 13, please. We're quickly here. In order to emerge from bankruptcy, essentially you have to negotiate agreement among most of your constituents on what the reorganization plan looks like. You have to provide, similar to SEC reporting type documents, a disclosure statement, which essentially provides the context of the company, what the restructuring looks like. It has to provide that this is the best interest for all parties to follow this plan. So you often see great debate and disputes happening in the Chapter 11 context between creditors and the company over the plan of reorganization. Creditors typically argue for higher enterprise value because it provides a higher return for them. But in essence, in order to emerge, you've got to build consensus. You've got to get your plan of reorganization approved by generally most of your creditors. Sometimes you can get a plan approved without having complete agreement, but for the most part, debtors try to get all parties to agree on the economic terms. Let's move on to page 14 and consideration of time here. So this last slide in this section talks about an accounting aspect of Chapter 11, that once you emerge from bankruptcy, depending on certain qualifications, debtors may have the ability to qualify for fresh start accounting, which essentially means you're restating your balance sheet to fair value, fair market value, versus what you may historically have been carrying your assets and liabilities. So essentially, you're a new organization, you're a new company, and you're restating your balance sheet accordingly. And so both assets and liabilities are impacted. So let's move on to page 15, which is our second polling questions. I don't know if there's any questions on my content. I'll pause for a second. No questions?
Great. Thank you, Scott. So that brings us to polling question 2. What types of costs are non-recurring restructuring related that a company would report separately in its income statement? A, bankruptcy counsel. B, fresh start accounting advisors. C, severance compensation. D, site location closing costs. Or E, all of the above. With that, we'll turn it over to Zach McGinnis.
Thanks, James. So the next few slides we'll go through are the probably more rich and compelling slides around accounting and financial reporting with respect to bankruptcies and restructuring processes. And this is a topic that a lot of our clients are challenged with in tracking and reporting separately the reorganization items in their income statement and preparing those files for audit. So we'll look at the results of the polling question here. All the above, 87% is the correct answer. So we'll go to slide 16. So the next few slides, as we mentioned, will be accounting and financial reporting related. One step prior to talking about Chapter 11 or Chapter 7 in the actual bankruptcy space, companies need to determine what their accounting model is for the restructuring activity, and that actually could be outside of ASC 852 or 205. And in fact, we have clients that who settle out of court For example, a debt for equity transaction where there's a change control event for relief of all the historical debt, could be under an accounting model called troubled debt restructuring under ASC 470, or extinguishment or modification accounting, which has very different processes and accounting treatment and disclosures associated with those accounting models compared to 852. 852 is probably the most complicated and time-consuming piece of it, as there's a lot of communications with bankruptcy courts. So just be aware that these slides will go through 852 specifically, but there could be varying accounting models and disclosures if there's an out-of-court settlement by the company. Let's go to slide 17. I'll hand it to my colleague Jason Tucker to go through some more accounting considerations.
Great, thank you, Zach. There are a number of process and considerations here that need to be considered while going through Fresh Start. A few of those we'll highlight here specifically that our clients are really challenged with. The first we'll discuss is emergence date cutoff. This is going to be a period 13 cutoff. It's going to look a lot like a year-end close. Some challenges our clients tend to face are the system's ability to add in a period 13 close, as well as a timing challenge for those of us that are public filers. The SEC does not grant any extensions depending on when the emergence date happens. So if you emerge March 15th, you still have the same number of days you would otherwise to file. So that really puts a lot of our clients under a squeeze from a timing and reporting point. The second item we're going to discuss that tends to be a challenge is reorganization items. We touched a little bit on earlier. This is an area where transaction-associated costs with the reorganization need to be properly captured, and those that are truly reflective of the bankruptcy, those are going to be your revenues, expenses, gains, and losses. We primarily focus, though, on expenses related to professional fees, legal fees, all those types of things. One challenge we do see is for those bankruptcies that last longer, good tracking tends to be more challenging, especially as staff come and go and you have a number of advisors. This is an area that's often heavily tested by auditors, and they really like to dig into the details and walk through different expenses. To help our clients, we generally try to keep everything separate and truly mark to the side as pertaining to the bankruptcy, just so we can avoid any adjustments or reclassifications between typically where we see reorganization items and SG&A costs over the course of that bankruptcy. We go to slide 18, please. There's a two-step qualification test to actually meet ASC 852. The first is a solvency test, and we can see that reorganization value of these assets in the emerging entity must be less than the total of all post-petition liabilities and allowed claims. This is generally a pretty simple test, but it's just there to ensure that the business truly is insolvent and incapable of paying off its liabilities. The next is a bit more challenging. It appears easy, but the change of existing voting shares immediately before the confirmation, and then the number of shares afterwards from a control standpoint. And it's more than just shares, but it's actually control. Things to consider are warrants, options, and other associated items. But once these are completed, then we can move on and make our ASC 852 selection and reporting. To be conscious, though, any errors along this way could result in reporting of, let's say, ASC 805, which is our business combination.
Yeah, just to jump in here, I think, it's not always straightforward like anything in life, as well as accounting policies for transactions. And this is an area where you got to meet both. It's not straightforward deciding early on before you go too far down the path and assume that 852 is your applicable accounting model. Documenting this and having your auditors consult the national office to make sure we're headed down the right path, because the menu of accounting options in these types of environments isn't always the most straightforward. So just make sure that you understand it and you go through the proper documentation and consultations before you head down the path under the wrong accounting model.
Thank you, Zach. Next topic we're going to cover is the reorganization value versus enterprise value. For those of us that have worked with valuation firms in the past, we know they tend to have unique opinions. Sometimes those opinions can take a while to receive. It's very important once the decision is made to get into bankruptcy to engage those advisors early and communicate with them often and connect them with our auditors quickly so that there's no time loss or lag in communication. Specifically to reorganization value, this is going to be reflective of the value stepped up post-emergence of our assets, and this is using a third-party valuation. Typically, we look at assets that are valued on an individual specific asset-by-asset basis, those that are more unique or larger in value, and then in batches or classifications that are generic or more type of standard assets. For enterprise value, we struggle a little bit often with our clients valuing the equity portion where there's other considerations, multiple classes of stock, common and preferred, as well as things like warrants and management incentive units, et cetera. For the long-term debt, this is our post-petition debt, things like our take-back notes, new bonds issued, et cetera, all interest-bearing long-term debt items here. Once these are valued and agreed upon, these are reconciled and reported in a fresh start footnote for those of us that are public filers.
Yeah, and accounting and valuation are always one and the same, right? So one, I guess, shortcoming a lot of our clients take is getting 2 or 3 valuation experts involved, one to value real estate, one to value business enterprise value, and they don't talk to each other. So you've got 4 or 5 starting points from a value perspective, and to determine the accounting and reporting for it, the disclosures, it gets very confusing and time-consuming to reconcile them together. So similar to a purchase accounting or business combination event, same in a bankruptcy fresh start situation, you generally want one advisor, one valuation provider. Now, they may get inputs into their one valuation conclusion from other experts, but just make sure that similar to the accounting exercise, the valuation exercise needs to be well coordinated, and there needs to be one, call it deliverable, so that the fresh start accounting can take place on all assets and liabilities of the business, not just picking up cost pieces, because our clients make that mistake and ends up being more time consuming and expensive to have too many cooks in the kitchen, so to speak, from a valuation perspective, to determine the fresh start step ups. One other thing is on the tax perspective, not to get too much into tax and to give my colleague Ryan Gamble a plug here, but in many cases there will be new deferred tax assets and liabilities that are triggered as a result from emerging from bankruptcy and applying fresh start. So for example, if you reset the book basis, net book value to 100, depending on how it's structured from a tax perspective, that tax basis could remain the historical tax basis. So you've triggered potentially new deferred tax liabilities, for example, that need to be tracked from the emergence fresh start date going forward. In other cases, you'll have tax basis that's stepped up on a consistent basis as book basis, and you may end up with a different allocation, tax PPA, if you will, than book PPA. But just be aware that the valuation, book accounting, and income tax accounting all really need to be on a coordinated basis, because there could be issues on that. And one area we've also dealt with from a tax perspective recently is a cancellation of debt income in a debt versus equity transaction out of court. So there could be real cash tax impacts to how you structure an emergence vehicle coming out of bankruptcy. And outside of just the boring accounting stuff, there could really be cash tax savings in how this is structured. Just make sure that early on you get the right tax accounting and tax legal advisors assisting management with how you emerge from bankruptcy, because there could be real dollars outside of just the financial statements that are impacted by this process. Go to the next slide. So the next slide here, I can't see it, but slide 20 is a snapshot of a company's emergence balance sheet and income statement. So if we think about a company reporting for 17 and 18, for example, this particular company emerged from bankruptcy on July 15th of 17. So the vertical black line that you see in your balance sheet is there for an intentional purpose. From a financial reporting perspective, in some cases, you'll see black lines. So the reader of the financials knows that they cannot compare 2 periods as the same, an apple and an orange, so to speak. Generally, a black line is introduced when you have a change in reporting entity so that the reader knows they can't compare that apple and that orange. Same in A52 Fresh Start, you have a physical vertical black line in your balance sheet, and similarly in your equity roll forward, you'll see that black line horizontally to show the reader kind of, here's the date in which we had our closing balance sheet as of on the predecessor basis, and we're going to introduce our new opening balance sheet on a successor Fresh Start basis, which if you look at the bottom right, this is called the 4-column footnote. So it's an actual footnote in the company's audited historical financial statements, really to show that walk across. First column being predecessor non-bankrupt company. The company closes its books, as Jason was saying, mid-month cutoff issues, because most companies don't close 13 periods in a year, they only close 12. So now they've got this 13th period that they've got to do cutoffs at an arbitrary date at Emergence that they normally have never done ever. And so they've got to communicate with their vendors to get invoices as of an arbitrary date in the middle of a month, close the books, which is that first column predecessor. Second column is reorganization adjustments. So this column reflects the legal transaction of the bankruptcy or potentially out-of-court settlement, where usually it's debt and equity. This is the most exciting part of this column, where the company will reflect the liability subject to compromise coming off the books at 100 and going into equity before the Fresh Start purchase accounting, if you will, impacts are applied. So that second column really ties out typically to the legal documents within the arrangement. And the auditors will definitely want to go through that and make sure the company has properly reflected the impacts of the legal arrangements in that column. The third column being Fresh Start adjustments. So think what most folks are used to in purchase accounting. So books step up to fair value. So for example, property, plant, and equipment was historically $135 million. The valuation experts recommend the company step up that to $25 million up to $160. So their Emergence fair value of PP&E then would be $160 million, and you have obviously incremental depreciation going forward on that new stepped up basis. As we were talking about from a tax perspective, that tax value could be 150, so you now triggered deferreds on the $10 basis difference between 160 and 150 new tax basis, as generally there's going to be a different step up from a tax perspective based on how the deal is structured. So that 4-column footnote is in the footnotes of the company's historical financial statements, along with a few other required footnotes around reorganization value, reconciling to enterprise value, and some other specific footnotes that are required by the standard. So this is just one example of an unusual one-time footnote, that disclosure requirement that companies generally wouldn't be used to. So then the company in the equity statement would roll forward that successor opening balance sheet on a stepped-up basis through 12/31/18, and that's really kind of the expansion of that black line presentation. So just a quick snapshot of what one of our clients had done in this scenario. Move to slide 21. So on 21, we're going to show a snapshot of what an income statement would look like in a period of reorganization under ASCA 52. So again, a vertical black line that's actually on the face of the P&L, showing the 16 period, predecessor 16 period untouched by Fresh Start. And then in 17, we've got January 1 through June 8 of 17. So the stub period, if you will, leading up to the moment 1 second before Fresh Start is applied. And then the far left column is the successor period from 1 second after Fresh Start through 12/31 of 17. The other key thing on this picture here is the line item called reorganization items common net, which is about 2/3 of the way down the financial statement line items there. So that's a ASCA 52 unusual new line item that a company normally wouldn't have, that is audited for completeness and accuracy. So this is a very major struggle for our companies going through distress to be able to capture bankruptcy expenses versus ongoing normal expenses. And so the tracking of that and the disclosure of that and the audit of that line is one of the top priorities in a ASC 852 type of arrangement. So just make sure your vendors are giving you a split out between reorganization type events and normal ongoing recurring business type events, so that the income statement can be reflected and disclosed appropriately. And we talked about those types. There's some gray areas as to what qualifies the reorg item versus what qualifies as a normal business ongoing expense. So just make sure that you have the right data from your vendors to be able to split those expenses out. So we'll go on to slide 22 for polling question 3. And I'm going to give it to, once I read it, I'll give it to Damon to go through some of our experiences. But the question is, which industry, and this is in 19, saw the highest number of Chapter 11 filings in that year? A, retail, B, real estate, C, energy, or D, manufacturing? So I'll give it to my colleague Damon Cade as the pollsters respond.
Hey, good day. This is Damon Cade. Glad to be with y'all. I'm out of the Houston office, managing director here, and like James mentioned, I have a heavy focus on energy. So I'm going to relate as I go through the presentation to some of those client experiences in the energy and utility sector where we've done some of this work recently here in the last few years. And I think our polling is done. Looks like retail is the winner there. So if we go to the next slide. So I'm gonna focus on 3 areas. One, preparing for filing. There's a lot of activities that need to go into that, a lot of stuff that our restructuring advisors need to prepare for around motions and information for those first day motions. But a lot of it is around what is the strategy for the bankruptcy. And there's a lot of different strategies, but ones I'm going to focus on is there could be just a reorganization of debt where the business is not going to change significantly, almost staying status quo. And I'll talk about some of those preparation steps there that we'll need to touch on here in a minute. There could be, hey, this is an asset sale. The company's going to go away and they're going to sell their assets, and there's a wind down view. And then there could be situations where you're carving out a piece of the business, or maybe not all of the business is a filer or debtor, where part of the business is going to have to run under like a DIP program, or debtor in possession, as we talked about earlier, versus other parts of the business will run, as it would without being in bankruptcy or status quo, if you will. A couple of key prior to petition filings that our clients typically need to address is really, focusing on, based upon one of those 3 strategies, focus on what they're going to do going forward. So maybe they have a COGS reduction, or they need to minimize SG&A. They need to start planning for a newer, lighter org. Maybe they have some projects that they currently have in process that they need to halt or stop, or maybe don't fit the strategy of the bankruptcy process or program that the company is looking to implement. Retention planning is very important, keeping the key people around, coming up with a program. Typically you come with the program after you file, but you're starting to plan for the program to keep key individuals, management team individuals, or key individuals to operate the organization retained throughout the bankruptcy process. A lot of work needs to be done on the system side, where you're preparing when you're about to file, or when that does file. And it can happen on a weekend, it can happen at night, it can happen a lot of times, is starting to decide or look at your pre-petition unsecured liabilities. And that's a lot of heavy work on the AP side of things, or any sort of receipts that have been received. On purchase orders, and going through that process systematically to update as soon as the filing happens. So we don't go and pay pre-petition invoices. Obviously, that will require an order from the court or upon emergence. So that's really, really key to get that information done. Plus, there's a lot of information we need to give to the who's ever doing the advisor work, financial advisor work, or the company's advisor work, to prepare first day motions and motions. There's company information. There is, the listing of our creditors and some of the stuff that Scott touched on earlier. So a lot of pre-planning, but mostly it's going to be around what is the strategy for the bankruptcy to prepare for that day one filing, like who you're going to call after you file. There may be key customers. There could be key vendors. What is your communication plan for your employees? Is my job going away? Is a company going away? To have a concise plan, and all that is really at the beginning prior to filing the petition. So if we go to page 24, we use the word fresh start here in this, not in the sense of accounting. Obviously, that is an outcome of the process. But this is a fresh view of the business. And like I said, not all cases you go through and you need to make drastic changes. But in a lot of cases, you're going to have to operate differently, and especially when you're under as you're a filer or a debtor in possession, you have to run your business differently. And some of those things are you're going to have to manage cash flow more carefully. You're going to have to optimize your working capital. So I'm focusing on reinvesting in the business here in the middle. We're going to be managing your cash flow typically on a 13-week basis. You're going to be managing and working with your lenders. You're going to be communicating quite a bit with various committees that are now involved with the bankruptcy process that have been appointed. You're going to be working with your financial advisors very closely to implement or look for ways to implement micromanage cash, both from a collections point of view and from a distributions point of view. So you're really getting down to the nitty-gritty on the working capital side to manage that. You're also going to look for ways to probably start reducing costs if your plan is maybe an asset sale. If your plan is, hey, I had a shared services organization that was costing me too much. I need to figure out a way to optimize that, and maybe that has a technology component. So there's a lot of different strategies that we touch when you're going through this reorganization process. I've done carve-outs where we had to stand up entire back offices where they have no systems, so then maybe there's a TSA involved, and you're trying to get off that TSA as fast as you can to reduce that cost. I've been on asset sale transactions where we are winding down and we want to close down projects and systems and folks. We want to operate the business as minimally as we can. So sometimes we go the opposite direction. We're trying to run it, less from a enterprise system point of view and more from a spreadsheet point of view. But we're trying to do it as efficiently as possible. But also when we're reinvesting in the business, one of the things that we need to really focus on is additional levels of controls and review, especially around disbursements. We want to make sure we're paying vendors that are post-petition vendors, or have post-petition liabilities, not liabilities that occurred prior to that. So there's additional reviews of when we pay people, when invoices come in, when the actual liability was taken, throughout that process when we're in that reorganization cycle. The last piece, and we'll talk on page 25 about this now, which we can go ahead and flip to, is when we come out and we emerge from bankruptcy, what does my organization look like? Do I have a new set of lenders? Do I have a new set of equity partners? Is my business, like I said earlier, is my business focused on standing up a solution or a carve out? So there's a lot of different factors there. Human capital definitely comes into play, retaining like the people I talked about earlier. Maybe you have a new organization, you have a new management team. That is a very large factor. They have new incentive programs. that we need to put in place. You're definitely going to have new budgets and financial metrics that drive their incentive program around human capital. Ideally, we're probably going to have new business systems or new management metrics or new reporting that we need to provide to our lenders. So how we do that and how we look at the business may change, right? So there's a large element of technology and process change that could come out on the back end of these emergence cycles, depending on the type of transaction that bankruptcy was. So that's all I have for my section here. I'm going to go to polling question number 4. How likely does your organization anticipate navigating a 2020 distress situation? And I'm going to go ahead and hand it back over to James Lee. Thank you all.
Great, thank you, Damon. While we're waiting for participants to respond, as I mentioned at the outset, we're extremely pleased to welcome Conway McKenzie into the Riveron family, bringing 30 years of practical experience helping clients navigate through difficult situations. As Damon highlighted and Zach, we have a long history of supporting organizations, optimizing the finance and accounting organization, assisting people with complex technical accounting matters and the like, but now we have far greater breadth and depth in terms of really advising clients through a restructuring situation. Paul, I know you've probably got some thoughts to add with respect to what your clients are seeing, and maybe you can tell us a little bit more about the practice and how you've advised people in the past and currently.
Sure. So to Damon's point, I think that Damon pointed out the process well. What I thought makes sense is explain a little bit more how it works, how people are impacted. So I was in court yesterday. In the courtroom, there were over 60 people, and I think that's an important data point to explain the huge amount of work a restructuring puts on people. So out of nowhere, on top of your normal reporting, you have to deal with diligence from your lenders, your creditors, maybe a change in the board. There's bankers involved, and lawyers. So there's a massive amount of additional work just to get that ready, answer the questions. So that's one. Secondly, the court requires you to file certain forms, to file accounting data on a monthly basis. That's likely a report that hasn't been done before, and it takes time. So on the one side, there's a greater demand on people. Accounting and finance, I think, are the groups mostly impacted here. And as Damon mentioned, one of the things that a bankruptcy court typically does is incentivizes people across the company to stay. So there are typically bonus plans that you would discuss before you file or before something happens to make sure that people stay. And then with this extra stress, there is for lack of a better word, upside to the people that do the work. And then looking back, we have been involved in about 31 cases, 31 energy cases in the last 4 years. As a general theme, companies that address the issue earlier, that involve advisors to help them typically go through the process quicker. They are better prepared. Strain on people is less, and it overall becomes a better process in a situation that is unpleasant. And I think finally, as you know, as companies have maybe vendors who have exposure, filing liens, and this is really more for OFS entities, but filing your liens timely, monitoring credit is important.
Paul, thanks very much. Well, we're about out of time. I want to thank, again, everyone who was able to participate on today's webinar. I also want to thank all of our experts for joining us today. Obviously, these can be challenging times, particularly for certain industries, but we'll get through those times. And so, to the extent that there are any follow-up questions, remember, along with the presentation materials that you'll receive, along with your CPE certificate, you'll also receive contact information for all of our experts. So should you have any follow-up questions, or if we can be of assistance to you in any way, please do reach out to your Riveron and Conway contacts. Thanks very much, and have a great day.